Hey, future elites, let's go one step ahead today. Let's do our best. Now, today we are going to look into a guide to the foreign exchange markets, which majorly known as the Forex markets. Okay, at first, let's look into what is Forex trading. Forex trading, it is the buying and selling of currencies to profit from the changes in exchange rates. Key facts about Forex. Forex is the largest financial market in the world with over $7 trillion traded daily. So, for instance, you own your own country currency, then you want to exchange it into another country currency. Majorly, traditionally, it is done by going to a nearest bank or to a broker. As I can say, back then we don't usually call them brokers, but that's majorly how I can say they are. So you exchange the currency there. They don't just offer you free service, they benefit from those changes in the price, and that's where they do get their profits. But now everything is modernized and it is digitalized. It is now digital. You too, in your house, in your home, on your bed, you can trade Forex. So let's look into how Forex works. Forex is traded in pairs. Forex cannot only be one single currency you'll be trading one. No, it is in pairs. Like as we are going, you buy one currency while selling the another. Be like here, I can say Euro USD. You are buying Euro and you're selling United States dollar. That's why it says Forex is in pairs. GBP USD, you're buying Great British Pound and you're selling United States dollar. USD JPY, you're buying US dollars and you're selling Japanese yen. And then Aussie USD, buying Australian dollar and selling United States dollar. So a key formula is like $1, €1, sorry, it's equals to $1.1. So you need $1.1 to buy €1. So that's majorly how Forex work. Let's look into the type of currency pairs, because we say Forex is traded in pairs and all the currencies are in pairs. So what are the types of those currency pairs? We have the major pairs. Those are the most traded currency pairs, like with a lot of volatility because it is most traded in many places. One, we have the Euro USD, GBP USD, and USD JPY. They are not the only major pairs, but I can say they are mostly gotten. As you can see here on this photo, I think that's why I inserted this photo. We have Euro USD, USD JPY, GBP USD, USD CHF, USD Canadian, Aussie USD. They are all major currency pairs, and there are a lot more than the ones listed here. And the next one, we have minor pairs. This one, it is called minor pair because there is no United States dollar involved in that pair. As you can see above, all those pairs, they have United States dollar in them, Euro USD, GBP USD, USD JPY, like that. But this one, they don't have any USD in them. For instance, we have Euro GBP, Euro Australian dollar, and then if you're going to look into this photo here, Euro GBP, Euro Aussie, GBP JPY, Euro CHF. This CHF means Swiss franc, and then GBP Aussie, Euro NZD, that's meaning New Zealand dollar, Euro New Zealand dollar. And then we have exotic pairs, that's the next one. But not always you go and be seeing exotic pairs everywhere, but I brought it here for the sake of the knowledge. These exotic pairs are major currency plus developing economy. Major currency, something of a sort of like USD or GBP or CHF, together paired with some developing countries currency, be like USD NGN, United States dollar, Nigerian naira, USD ZAR, that are like that. If you're going to look here, we have all of these USD MXN, that's Mexican there, so they're all like that. The next thing we're going to look, what is a pip? Here I can say, if at first you were distracted by something, please, now we are diving into the most aspects of forex trading, something you have to understand. If you did not understand these basics, zero it, you know nothing about forex, and hardly forex will be yours. So let's look into what is a pip. It says pip is equals to a price movement unit. Pip is the smallest movement in a currency pair. That's the smallest change in a currency pair. Be like Euro USD. When Euro USD it is 1.1000, then it moves to 1.1000. Be like you are buying euro with your United States dollar. That's buying euro and selling United States dollar. So each euro costs $1.1. So whenever the price moves to $1.1001, then we say there is a movement of 1 pip. So if we are going to look into this photo, if I'm to say, that's how majorly you will be seeing prices in forex. You see them like this, with these 4 digits after the dots, and sometimes the fifth one you see it's above as a very little superscript. So it's still called a pip, but some people address it as a minor pip or micro pip, but yet still it's still a pip and it counts. So someone might say, why pip matters? Yeah, pip matters a lot, because pip will give you the foundational understanding in forex trading, and profit and losses are measured all in pips. If you know how to calculate your pips, you can calculate using your standard your lot sizes, sorry, and your pip. You will calculate either your profits you're going to get in a trade or the loss you're going to lose in a particular trade. So I called lot size earlier. Now let's look into what's lot size. We have different types of lot size, which include the standard lot size, mini lot size, micro lot size, and not always this nano lot size it's included, but I brought it here because there are some other brokers that support trading nano lot size, and you see it. Let it not be you don't have any idea about it. Now, what is lot? Lot is equals to your trade size. Types of lot size. We have the standard lot size. Standard lot size, it's equals to 100,000 units of what you are buying, and mini lot size equals to 10,000 units of what you are buying, that particular currency pair you're buying. Then micro lot size equals to 1,000 units of that pair you're buying, and nano lot size equals to 100 units of that pair you're buying. Let me give you an instance. An instance of lot size be like, we have Mr. A, Mr. B, Mr. C, and Mr. D. They are all dealers. They sell biscuits. And Mr. A bought 100,000 cartons of biscuits, and Mr. B bought 1,000 cartons of biscuits. Mr. C bought 1,000 cartons of biscuits. Mr. B bought 10,000, Mr. C 1,000, and Mr. D got only 100 cartons of biscuits. So now, in a common sense, who have the much profits there? It's Mr. A, definitely, because Mr. A have 100,000 cartons of biscuits, of which if he sell all those 100,000 cartons, he will be having much more profits than Mr. B, Mr. C, and Mr. D. And if Mr. D sell all his 10,000 cartons of biscuits, he will be having much more profits than Mr. C and Mr. D. Likewise, Mr. D will be having much more profits than Mr. D. So that's, I can say, a simple understanding of lot size. And always lot size matters. Your trading size matters whenever you're going to enter into a trade. So let's look into this. Sometimes you see where you're going to insert your lot size. So 0.01 lots, it's equals to micro trade. That's it equals to micro lot size. That's 1,000. You can insert 0.02, meaning 2,000 units of what you're buying, and 0.03 meaning 3,000 units of what you're buying. And still, I can say this 0.01 lot size, it is very ideal for beginners. That's advisably what I personally gonna advise you as a beginner to be using. And 0. Okay, let me not forget this. Say 0.1 lot size means one mini lot size. 0.2, 0.3, 0.4 means it means four mini lot size, and one lot size means 100,000 units of what you're buying or what you're selling. That's one standard lot size. Put this at the back of your mind. It's going to be useful in your trading journey. Now let's look into what is leverage. Back then, not everybody have that huge amount of money to be buying or to participate in the forex market. Only the multi-millionaires, the rich, only trade forex. But now, due to advantage of globalization, digitalization of every aspect, and I can say the privilege we got from this leverage of a thing. That's why everybody can trade forex with the minimum of $5, $10. Yeah, you can trade forex. But back then, even if you can access the forex markets, if you don't have huge amount of money, you cannot participate in the forex market. Now let's look into what is leverage. Leverage allows traders to control large positions using with just small capital. With your just $100, you can control a position of $10,000, a position of $100,000. That's the beauty of leverage. But regardless, as it has its own advantage, definitely it's gonna be having its own disadvantage. For instance, example, let's look into this, because that's how usually you'll be see leverage written as either 1:10, 1:100, or 1:1. Like that. 1:1 means each of your $1 is equals to still that $1. But for instance here, 1:100, it means each one of your $1 represents $100. So if you deposit $1 into your account, and with a leverage of 1:100, you can trade up to a $100 position in that particular account, because that your $1 it's multiplied by 100. And if you deposit $10, then you can trade an amount that can exceed $100. It can reach maximum of $1,000, because 10,000 because $10 times 100 equals to $1,000. So let's look. For instance, 1:100 leverage. You deposited $100 into your account. $100 with a 1:100 leverage, $100 can control $10,000 positions. So don't get this. That is $100 times 100 equals to the $10,000 position you could manage, or I can say you could open. Advantage of leverage: higher profits possibilities. And definitely, I told you, it has its own disadvantage, and that's if you misuse leverage for real. So risks of using leverage: there is higher losses. Like the losses, it increases the chance of you losing a huge amount of money. That's if you don't know how to implement the good use of leverage. So be cautious and use leverage responsibly. And the next thing we are going to look into, it is what is margin. You have to understand all of this. Okay, a margin, it equals to security deposit, money required to open a trade. So for instance, you deposited $100 into your account with a leverage of 1:100, that you can open a position of $10,000. Then you try to open a 0.1 lot size of a position. So the amount you're gonna risk, like the amount you're willing to put into that particular trade, the amount that will be secured, and be that's the amount controlling that particular trade, it's what we call margin. Those that study accounting or those that know a lot about economics would definitely know this margin as simply as it could be. Maybe I cannot break it down to how you understand, but let me try my possible base. Because an example is position of $10,000 in a leverage of 1:100 leverage account requires only margin of $100. So for you to trade a $10,000 account with a leverage of 1:100, you only need to deposit $100. That's be like you go to a bank, I need particular amount of money from you, and this is the margin I'm willing to put into. Mind you, not like a loan we call that one collateral. So these as simple as I can say I can put margin, because I don't have any other means to explain margin to how you might understand. But regardless, key points: no margin, no trade. Don't forget this one. And another thing is understanding spreads. You will keep wondering, like earlier in this video I already said a little about how profit is made in forex trading. So this spread, I can say that's the actual profits in trading. So what is spread? Spread is equals to trading cost. That's the difference between buying price and the selling price. Usually in the forex terminology, buying price we call it asking price, that's the ask, and the selling price we call it bid, that's the bidding price. So for instance, euro USD bids at $1.1, 1.1000, and the ask it is 1.1002. The spread is equals to 2 pips. The spread is equals to 2 pips. Just minus this asking price, just minus this bidding price from the asking price, and you get the actual number of the spreads. So that's as easy as it is. If you can see here, like the bidding price here at this photo here, the bidding price and the asking price, if you minus this bidding price from the asking price, there's a difference of this 1.8 pips, because here there's this micro pip that I said. That's why you see it's 1.8. It is 18 here, then it's broken down to 1.8 pips. But this one, as you go deeper, you get to understand all of these things. So that's spread, the difference between the buying price and the selling price, and these the profits I can say the brokers make. That's how the brokers to make their own profits. So always don't forget, lower spreads is equals to better prices, because lower spreads, I can say that spread, it's kind of a profit to the broker and charges to you. So the lower it is, the better it could be to you. The higher it is, the worse it could be to you. That's all about spread. And then let's look into this, because in that spread I mentioned something like broker. That's how brokers made their profits from spread. So let's see this as broker is the middleman between you and the forex market. Broker is the one who gives you access to the forex market. A forex broker connects trader to the markets. Popular brokers are things like XNEX, IC Markets, Pepperstone, XM, FBS. You just couldn't go randomly and choose a broker and be like, I just want to trade, I want to work with this particular broker. No, it doesn't work like that. Some brokers are scam for you. Let me not lie for you. So there are some kind of key things you have to look before choosing a broker. Number one, it is their regulations. Number two, how low their spread is, because definitely sometimes spreads will be affecting you in your trade. Higher charges will be affecting you. Maybe whenever you start trading, you get to notice all of that. And this photo here, I can say, elaborates more on a broker, because you as a trader sitting in your room, broker serves as a bridge that provides you technology, liquidity, connectivity, and opportunity that connects you to these global markets, and it gives you 24/5 access to the forex markets, all of it, where you can trade all currencies available in the forex markets all over the world, while still in front of your screens, in your office, in your studio, in your room, or on your bed. And another thing, you have to understand this, because I can say these are the bedrocks of trading forex. Another thing is trading session, because we all know forex is a 24 hours market, non-stop, from Monday to Friday. Forex is only traded on weekdays, not on weekends. But there are other financial markets that are still traded in weekends, but not forex. So what is trading session? Because forex markets opens 24 hours, it's works tirelessly, I can say around the clock. So trading sessions, I can say, usually happens due to where those particular trades are mostly taken. Because if you know anything about geographical zones, or how the earth eats, how the earth orbits, how the earth rotates, you get to know it will be night to you here in your country, but far away in another country it's midday. So they are active. So just you, because of you trade forex, you're sleeping, it's night to you. They shouldn't trade forex? No, they will. So that's why I can say forex is divided into trading sessions due to the times in different countries. And the main sessions we have are Sydney, Tokyo, London, New York, and I forgot to insert another one here, but I'll do my best to elaborate it on my next video. So these sessions that we have, four of it here, if you're gonna look, like, they're all name of countries, they're all name of cities. Why are they named after cities? Because those sessions are mostly traded in those particular cities. That's why they are named after those cities. And the best sessions to trade, it is always London plus New York overlap. So you have to understand something here. Sessions are open for only 9 hours. Each session, Sydney, Tokyo, London, New York, have its opening time and its closing time. We are going to discuss this one too, because I don't want the video to be too bulky and too long. That's why I've not inserted it here, but we are definitely going to elaborate this on a separate video. And the best session to trade, it is most liquidity and volatility sessions, which I can say London and New York overlap session. It's a very good something. And then not this, forex is open for 245, only 5 days a week. Regardless, there is something I want to tell you, this a hint: always prefer to trade, if you're a day trader or a scalper, prefer to trade when two or more sessions are open. Because whenever one session is open, like, the market will be so quiet and there wouldn't be high volatility, so your trades will be too slow and you wouldn't be understanding a lot of things you'll be doing there. So these another secret I can say successful traders hold. So another thing we have to look, it is this bullish and bearish market. Bullish market first. Bullish market, it is when prices are rising upward. A lot of times you'll see those instances are represented by this bull, because in forex, bulls mean buyers, and buyers push markets upward. So whenever there is a bullish market, always look for buy opportunities. Don't always try going against the markets. Whenever you see bullish trends in the markets, just look for buy opportunities and follow the trends too, because you're there for profits, not to be right or go against anyone. And bearish market means prices are falling. You see everywhere red. That's, I can say, as a layman to a layman understanding, sorry, everywhere red. So prices are falling, and whenever prices are falling or going down, look for selling opportunities. Look for selling opportunities. Prices shouldn't be falling and you say, I want to buy, I want to buy. No, don't do that, except if you want to buy the dip, and buying the dip hardly happens in forex. So another thing, we know it is buying and selling, but the buying and selling, we order things cannot. There are different types of orders. Let's look into this type of orders. We have the market order. This market order means instant buy or sell. Whenever you select a market order while entering a trade, means you are executing your trade at that particular instant with the current market price. Be like, let me say, in these charts, in this photo here, the price is at 1.0854, and you just tap on sell, so it will immediately sell at this price, or it will buy at this particular price. So that's market order, instant buying or selling. And there's buy limits. This buy limit means buying lower. Be like you analyze your markets. Let me use this photo for instance. You analyze your market and you have your point, your pure eye here. That's point of interest where you want to buy. And hopefully maybe you couldn't be around by then. Then you set on your buy limits. And you setting your buy limits, automatically the broker, whenever the prices comes down here, it will immediately trigger the trade. You're already into the trade because you set a buy limits and they sell limits. That's selling higher. Whenever prices goes up, hopefully we are thinking there will be a little bit, if not a total downfall of that price, so that the markets, even if it is bullish, still there will be bears because the buyers still want to sell for profit. So for instance, instead this same trade, this photo here, right above the current price of the market, then you insert your sell limit here. So whenever, even if you are not on your system or you're not there to execute the trade, if you set your sell limit and the price comes above here, automatically it will trigger and you will be into the trade. And another thing, it is stop loss. That's automatically lose protection, sorry. Be like you instantly buy this particular currency pair, euro USD. In this particular photo here, I'm using this one as an instance. You buy it at this current market price, then you come to this particular lower low here and you insert your stop loss here. So maybe you risk $10 for that, and whenever the price comes down here and trigger your stop loss, so it will automatically take you out of that trade and you're gonna instantly lose just your $10, and there will be no more further losses because that's where you set your stop loss, and that's where I can say where you insert the amount you wanna risk in that particular trade. And another thing, it is take profits. Still using this photo as a reference and instance, you buy at this current market price and then the price move your way, it goes up above maybe to this particular recent higher high here, or let me use this one here. So whenever it comes here, automatically it will take your profit and store your profits and take you out of the trade, even if you are on your system or you're not. That's the use of take profits. That's automatically profit collection. And another thing, risk management. That's the most essential something I can say in trading. If you have no risk management, for really no doubt you are never gonna make it in trading. Naming all life for you. That's the truth. And this risk management, I can say, it's the bedrock of a lot of beginner traders giving up. So the golden rule for risk management: never risk more than 1 to 2% per trade. That's more than 1 to 2% of your account. That's if you are trading, let me use an instance of $1,000 in your account. $1,000 account, your 1 to 2%, it's $10 to $20 of your $1,000. So you risking $10 to $20 in $1,000, it's kind of nothing much. There is another video I'm gonna do to elaborate more about this risk management. Definitely we are gonna see a lot there then, and a lot of strategy will be said about this risk management thing. And then another thing, it is to diversify investment. Don't just be like you, since you're in this particular trade, you only be in this whether you lose or you gain profits. No, you can diversify where you want to enter trade. You can enter different currency pairs, just that know what you are risking. Don't risk too much of your account. Don't blow your account. Something you must, whatever, don't blow up your account. Then another thing, among this golden rule, I can say this is the number one golden rule: protect capital first. Profit comes later. That's just it, because you're there for profit. But if you don't protect your capital, for really profit, it's not gonna come. That's the plain truth. And don't forget, always use stop loss. That's for proper risk management. Always use stop loss. Always use proper lot size. Don't go on $100 account and be using one standard lot size. That's the huge mistake maybe you ever do in your life. Just 10 pips movement, boom, your account is gone. And then have a very good trading plan. Don't forget this one: journal your trades. it will be useful. Definitely it will help you track all your records, your progression, and whatever. And things you need to avoid while trading as a form of risk management, it is over trading, revenge trading, and emotional trading. This, I already posted a video already about this. Maybe you can go and look for that video in my TikTok page with the username at amzmezere. So let's look into this. Common forex traders we have different types of traders. It's left over for you to choose which one you want. Number one, it is scalping. That's a scalper trader. This particular type of traders enter a trade for a few minutes, sometimes seconds, and those type of traders, they open a lot of positions at a particular time, or one position with a very high lot size, just for them to gain a lot of profits at an instant, few little minutes, and boom, go out of the trade. But this is too risky something as a beginner. That's to be truth. Learn technical analysis a lot, know a lot more about fundamental analysis, and practice a lot about this scalping. Definitely you're going to be good one day. And then day trading, some day trades, because day traders enter trades in that same day and still goes out of that trade in that same day. Let me say this: scalpers usually use 5 minutes time frame in their charts and 1 minute, while day traders uses, I can say, little of 15 minutes time frame, 30 minutes time frame. Those scalpers too uses 15 minutes, but mostly I can say sometimes the day traders too uses 15 minute time frame, mostly 4 hour time frame for seeking of direction, then 1 hour time frame for analysis, and 30 minutes time frame for entries. That's for day traders. They enter trade that same day and goes out of that trade same day. They don't hold position overnight. You can read what's written here in the photo here about all those traders. It will be so useful because I don't want this video to be too long. That's why I'm just rushing and kind of cutting a lot of things. And the next one, it is swing trading. This particular type of traders hold position for days, sometimes weeks, and this is something I can say I'm a very good at, especially in terms of currency pairs. The swing trade, I love it the most. For really, not high risk but high gains. That's for swing trading. And the last but not the least, I can say it is position trading. This particular type of traders open position and hold it for weeks, months, or years. These particular positions are usually held by whales, that's the riches that trades billions of dollars, or institutions that trades millions and billions of dollars. So they hold position for a quite very long period of time. Another thing, it is trading psychology, because for good, if you are becoming a trader, you have to change your psychology. Your psychology doesn't have to be normal with the rest of the people. Traders have different type of psychology, and you have to build your own psychology before you become profitable in this trading space. That's the absolute truth. Number one thing, it's your biggest opponent is yourself. In trading, you don't have any opponent, just that the big boys, the banks, the institution haunts you. If you know your ways and you have the best psychology, or a very good psychology I should be saying, you definitely outsmart them and you never get yourself caught. So if you see you messing up in trading, it is just you, because trading will mirror you, will mirror everything about you, will mirror all the bullshit or the rubbish you're taking into yourself back to you. So what you will need to control as a form of very good psychology, number one, it is your fear. FOMO. You have to control your fears. Sometimes you have to face your fears too. And another thing, it is greed. Don't see profits in trades and be like, I need much more profits. No, you're just gonna lose everything maybe at an instance. FOMO, that's fear of missing out. Just sometimes maybe there's a huge movement in a trade, and because you're fearing to miss out, you just bought into that trade, and at the end of the day you end losing huge amount of money there. And that is this FOMO. And impatience, like for good, this impatience. Sometimes you wouldn't wait for price to come to your point of interest, to your entry. You just bolt into trades. You'll be going against your rule. seriously, that's another killer in trading, because successful traders usually focus on discipline, and everyone who is gonna advise you about trading will tell you to discipline yourself so very well. And there are some common mistakes that beginners do usually while starting to trade. Let me highlight a little bit of them here. Number one thing, it is no stop loss. Like you feel like you're good and you can risk whatever amount, you will not be using stop loss. That's a very bad thing and a killer and an account blower in trading, as for you as a beginner with little capital. And another thing, it is using high leverage. Maybe on a $10 account you're using 1:1000 leverage. It makes no sense. That's the truth, because you are exposing yourself to a higher chances of losing huge amount of money. And trading news without knowledge, there are news, things like FOMC, NFP, they're all different types of news that you can trade. So seek knowledge about fundamentals before thinking to trade out all those particular trades, because during the instance of those news, there is high volatility and the chart moves, if this upwards, like as fast as it's cold. So seek knowledge and you're gonna enjoy it. Another thing, it is risking too much. As a beginner you'll be like, let me just risk, because if I risk a lot I will gain a lot. No, have a particular fixed amount you're gonna be risking. That's a little percentage of your account. Like for instance, on $100 account, I personally advise risking 5% of your account, because 5% of your account you need to take 20 different trades before you lose all of that account. Just think of it. And the next thing, it is following signal blindly. Just you find that signal telegram group, the signal telegram channel, you keep on following signal blindly, you're gonna lose everything in trading. That's the truth. And another thing, it is FOMO trading. That's the fear of missing out, I already talked about earlier. Then investing without research. There is no smartness in investing without making your own research. Before you put your money into anything in Forex, look at it very well, make good research, know a lot about it as much as you could before putting your money into it. That's a very wise financial decision you could ever make to yourself. Then solution for all these beginner mistakes, it is learn, practice, then improve. That's the truth. And another thing, in forex we have demo and live account. So there are a little bit difference, or I can say huge difference of, sorry, not little, between this demo account and live account. Demo account, you're only trading numbers and money that is not yours. That it is always important and useful for learning purposes only. That's demo account. But live account, it is real money, real pressure, real result. Like here on this photo, it's be like you are on a football pitch with zero audience, zero viewers, zero supporters. You play the way you want, you do all nonsense or rubbish, and it costs you like zero thing. No mistakes, whatever you do it's right to you, because it's you only that can judge yourself. But on the other side, that's the live account, be like, you are in a football pitch and you have thousands of audience, like a lot of people looking after you, a lot of people expecting something good from you. Then that one could bring a lot of a pressure, a lot of feelings that you have to focus before you gain something from it. Now let's look into demo account. Demo account means virtual money, money you don't see, you can't withdraw, it's just plain numbers there, and it's majorly used for learning, and it gets no risks because you're not going to be charged, and whatever you lose, you're just losing numbers. That's it. And for live accounts, it is real money, real emotions. And for recommendation, I can say it's to practice demo before you dive into the live account. And another thing, it is forex trading roadmap. If I'm to say, in this photo you can see how the roadmap is designed, like follow it, it will definitely be useful. Because step one, learn forex basics, anything, everything. If you don't have the fundamental about the particular thing, you don't have it basics, kind of, you're just doing rubbish. That's the truth. And step two, understanding risk management. You know the basics, you start trading, but you don't know anything about risk management, you don't manage your risks, like it's just bullshit, you only keep losing. And another thing, it is open demo account for practice, and the Fourth step, it is develop your strategy, your own strategy if you could. But if you have a strategy you learned, practice those strategy using your demo accounts. Practice those strategy like your life depends on it, because definitely your life depends on it, and you love that freedom of being profitable. And the fifth step, it is trade small. Start trading with a live account, but trade a little. Don't over exaggerate, don't go too far. And step 6, it is scaling gradually. Don't say I must go up there at once, I must take just one trade that it will give me everything I will be needing in life now. Forex doesn't work like that. Totally trading is not like that. And for the final thoughts I'm gonna give here, maybe as a little mentor as I am, forex trading is a skill, and any skill you have to learn, and definitely any success requires education, discipline, patience, risk management. You cannot learn skills without these four things that are here. You have to learn, you have to discipline yourself, and you gotta have that patience, and that risk management shows you know what you're doing. Remember, don't forget, I am putting emphasis on this: protect your capital first, profits will definitely come later. And last but not least, I can say this content is just for educational purposes and not financial advice a lot of times. So for more videos like this, tutorial videos like this, you can follow me on my TikTok page at amzmizere.com, and you can join my academy at whoop.com/amz trading academy, and hit the like button, subscribe to this YouTube channel, so that you keep getting updates about our new videos, and a lot more interesting videos about crypto trading and forex trading, all together with this stock and synthesis and indices trading will soon be coming. Just be expecting. All the best. Good luck, future millionaires.